The silver market changed forever in September 2020. Something happened that day that nobody expected. The biggest banks in the world stopped fighting against silver. They stopped selling. They stopped manipulating. After decades of keeping prices down, they suddenly walked away. This is the story of what happened and why it matters. For years, 4 major banks controlled the silver market. JPMorgan Chase, HSBC, Bank of Nova Scotia, and Deutsche Bank were the giants. They had power. They had money. They had influence. These banks didn't just trade silver. They controlled it. They decided when prices went up. They decided when prices went down. Regular investors had no chance against them. The manipulation started around 2008, maybe even earlier. The banks used a simple strategy. They would sell huge amounts of silver they didn't actually own. These were called short positions. When you short something, you bet the price will go down. If you're big enough and powerful enough, you can make the price go down yourself. That's exactly what these banks did. The technique they used was called spoofing. It sounds complicated, but it's actually simple fraud. Here's how it worked. A trader would place a large order to sell silver. This fake order would scare other traders. They would think someone knew something bad was coming. They would start selling too. The price would drop. Then the bank would cancel their fake order before it executed. They never actually sold anything, but the damage was done. The price was lower. The bank could then buy silver at the cheaper price. This happened thousands of times, day after day, year after year. The silver market operates mainly through something called COMEX. This is the major exchange where silver futures contracts trade. A futures contract is a promise to buy or sell silver at a future date. Most of these contracts never result in actual silver changing hands. They're just paper promises. This is where the banks had their power. They could create millions of ounces of paper silver with just a few clicks. Real silver miners had to dig it out of the ground, but banks could create paper silver instantly. By 2019, JPMorgan alone held short positions representing about 200 million ounces of silver. That's a massive amount. The bank was betting against silver on paper. But something else was happening at the same time, something sneaky. While JPMorgan was publicly shorting silver in the futures market, they were quietly buying physical silver, real silver bars, real silver coins. They were storing it in vaults, lots of it. This strategy was brilliant in a criminal way. They would push prices down with their paper shorts. Then they would buy physical silver at the low prices they created. They were playing both sides. They were the house and the player at the same time. Regular investors lost money. The banks made fortunes. Analysts started noticing this pattern. A man named Ted Butler spent decades researching silver manipulation. He wrote about it constantly. He called out JPMorgan by name. Most people thought he was crazy, but he was right. He calculated that JPMorgan had accumulated somewhere between 600 and 750 million ounces of physical silver by 2020. That made them the largest private holder of silver in the world, all while publicly betting against it. The authorities finally started paying attention. The Commodity Futures Trading Commission began investigating. So did the Department of Justice. They looked at trading records. They found the proof. The spoofing was real. The manipulation was real. Traders at these banks had been breaking the law for years. In January 2018, the CFTC filed charges against HSBC and UBS. The evidence was clear. Traders had placed thousands of fake orders. They manipulated gold and silver prices repeatedly. The banks had to pay penalties. HSBC paid $1.6 million. It seemed like a lot, but compared to what they made from manipulation, it was nothing. Then came the big one. On August 19, 2020, Bank of Nova Scotia agreed to pay $127.4 million. The bank admitted to manipulating precious metals markets. They admitted the spoofing. They admitted the fraud. This was huge. A major bank finally admitted what everyone suspected. But the real earthquake came on September 29, 2020. That's the day everything changed. JPMorgan Chase agreed to pay $920 million, nearly $1 billion. It was the largest spoofing penalty in history. The bank didn't just pay, they admitted wrongdoing. They confessed. For 8 years, from 2008 to 2016, JPMorgan traders had manipulated the precious metals markets. They placed fake orders. They spoofed the market. They broke the law thousands of times. The settlement included payments to multiple agencies. The CFTC got money. The Department of Justice got money. The SEC got money. JPMorgan also agreed to a deferred prosecution agreement. This meant if they stayed clean for 3 years, the criminal charges would be dropped. But the damage to their reputation was done. The truth was out. Something else happened around the same time. The banks started covering their short positions. Covering means buying back what you sold short. From June to October 2020, JPMorgan eliminated their entire 200 million ounce paper short position. They went from being the biggest silver shorter to having no short position at all. Some analysts believe they actually flipped to being net long. This means they now owned more silver than they owed. Why did they stop? Several reasons. First, the legal pressure was intense. The fines were massive. Criminal charges were on the table. Traders were going to jail. 3 JPMorgan traders faced criminal prosecution. One of them, John Edmonds, pleaded guilty. He admitted he spoofed the markets. He faced prison time. This scared other traders. Nobody wanted to be the next one arrested. Second, the strategy had worked perfectly. JPMorgan had accumulated a historic amount of physical silver. They bought it cheap by manipulating prices down. Now they owned it. They didn't need to keep prices low anymore. In fact, they wanted prices to go up. Higher prices meant their massive physical holdings became more valuable. Third, the market was changing. More investors were paying attention. Social media made information spread faster. Reddit forums like Wall Street Bets started talking about silver manipulation. Millions of regular people learned what the banks had been doing. Some tried to start a silver squeeze in early 2021. Though it didn't fully succeed, it showed the banks that public awareness was growing. Fourth, industrial demand for silver was increasing. Solar panels need silver, electronics need silver. Electric vehicles need silver. The world was using more silver than mines could produce. Supply deficits were becoming common. The banks saw this coming. They positioned themselves to profit from rising prices instead of falling ones. The impact of the banks stopping their manipulation was immediate. Silver prices started behaving differently. The extreme volatility decreased slightly. The sudden price smashes became less frequent. These were the moments when silver would drop several dollars in minutes for no apparent reason. They happened less often after September 2020, but the bank's exit wasn't the end of the story. It was the beginning of a new chapter. With JPMorgan out of the short side, other banks still held short positions, but they were smaller. Bank of America had shorts. Citibank had some, but none matched the scale of what JPMorgan had been doing. The commercial bank's net short position in silver, which had been massive for years, started shrinking. By late 2020 and into 2021, it had decreased significantly. This was unprecedented. For decades, banks had always been net short in silver. It was their standard position. Now that was changing. Some conspiracy theories suggested JPMorgan knew something big was coming. Maybe they saw inflation on the horizon. Maybe they knew about coming supply shortages. Maybe they had inside information about industrial demand. Whatever the reason, their timing was impeccable. They covered their shorts just before silver began a historic rally. Silver opened 2020 at around $18 per ounce. By August 2020, it had spiked to nearly $30. It then consolidated, but remained elevated. By 2025, silver had surged to over $60 per ounce. JPMorgan AIS 750 million ounces that they bought at average prices around $15 to $20 were now worth exponentially more. The manipulation had paid off spectacularly, not for justice, but for JPMorgan's bottom line. The regulatory settlements raised important questions. If JPMorgan manipulated silver for 8 years, who's to say manipulation ended completely? The bank admitted wrongdoing only through 2016. Their behavior from 2016 to 2020 wasn't officially part of the settlement. Could manipulation have continued? Some analysts think so. Others believe the increasing scrutiny made it too risky. The $920 million fine sounds massive. But context matters. JPMorgan is the largest bank in America. Their annual profits are measured in tens of billions. The fine was significant, but not devastating. Some critics argued it wasn't enough. The profits from 8 years of manipulation likely exceeded the penalty by a wide margin. This raised the question, do fines actually deter crime, or are they just a cost of doing business? The human cost was also significant. Thousands of silver investors lost money because of manipulation. Small mining companies struggled because prices were artificially low. Workers lost jobs. Communities that depended on silver mining suffered. Yet none of these victims received compensation from the settlement. The money went to government agencies, not to the people who were harmed. Deutsche Bank faced similar accusations. In 2014, they were sued for manipulating silver prices. Documents later revealed through the case showed evidence of coordination between banks. Chat logs showed traders at different banks communicating about their positions. They knew what each other was doing. Whether this constituted conspiracy or just market awareness remains debated. HSBC's role was significant too. As one of the banks that set the daily London silver fix, they had outsized influence. The fix is a daily benchmark price that affects the entire global market. If the banks setting the fix were manipulating it, the impact spread worldwide. HSBC paid penalties and faced lawsuits, but never admitted manipulation to the same degree as JPMorgan. By 2021 and 2022, the landscape had shifted completely. The Big Four were no longer fighting silver. Some had even become supporters of higher prices through their physical holdings. New players entered the market. Retail investors bought physical silver in record amounts. Premiums on silver coins and bars soared. Sometimes, physical silver sold for 30 to 40% above the paper price. This price disconnect showed the market was broken. The divergence between paper and physical silver became stark. You could buy paper silver on COMEX for $25 an ounce, but try to buy a physical coin and you'd pay $35. This made no sense in an efficient market. It suggested the paper market was still manipulated or at least disconnected from reality. The banks might have stopped their most blatant spoofing, but the market still wasn't functioning properly. COMEX itself faced a crisis. In March 2020, during the pandemic panic, the exchange nearly broke. Physical delivery requests surged. The banks had sold far more paper silver than physical silver existed in the vaults. They scrambled to meet delivery obligations. Some changed the rules to allow different forms of silver to qualify for delivery. This raised questions about whether the paper market was really backed by metal at all. Investor awareness grew dramatically. More people understood the difference between paper silver and physical silver. More people demanded delivery. More people stored their silver outside the banking system. This shift in behavior reduced the bank's control. If investors don't trust paper promises, the bank's power to create unlimited paper silver becomes worthless. The story of the big four banks and silver is really about power in markets. Free markets are supposed to set fair prices through supply and demand. But when a few powerful entities control a market, it's not free anymore. It's rigged. The silver manipulation showed how easily big banks can break rules when enforcement is weak and penalties are small. The day the banks stopped fighting silver marked a turning point. Not because justice was served, not because wrongs were righted, but because the most profitable phase of the manipulation had ended. They had accumulated their physical positions. They had paid their fines. Now they could let prices rise and profit from the other side of the trade. For regular investors, the lessons are clear. Markets can be manipulated. Big banks have more information and more power. Physical assets are different from paper promises. And sometimes the best way to profit is to understand what the big players are doing and position accordingly. The silver market today still bears the scars of decades of manipulation. Prices are higher, but volatile. Trust is lower. More trading happens outside traditional exchanges. More investors hold physical metal. The banks still participate, but their dominance has weakened. September 29th, 2020 will be remembered as the day the truth came out. The day a major bank admitted years of fraud. The day the biggest short position in silver history was eliminated. The day the big four stopped fighting silver and started joining the other side. Whether this represents justice or just the next phase of manipulation remains an open question. But one thing is certain, the silver market will never be the same.